Hey, what's up everybody? This is Alan here from the Equity Traders, the Academy division, and I'm going to be going through Learn to Trade Chapter 4, Video 3, and we are busy discussing the types of traders. And as mentioned in previous videos, this is very important for you to understand what kind of a trader you are before you even place one trade, because the type of trader will be determined basically on the time frames that he trades. And, if you don't know what time frames you're going to trade, then you actually have no idea about your strategy that you need to trade. So, in order to determine what kind of a trader you are, you can watch the previous video where we discussed, other traders, and we're going to complete that. And let me just go to the section, Learn to Trade Chapter 4. You can find this under the Academy part of the lesson. Alright, let's quickly go there. We discussed a position trader before on the previous video. We've discussed position traders, which are long-term traders. We discussed a day trader, which I do, where you open and you close trades in minutes, hours, but by the end of the day, you've closed your trade. We're now going to discuss swing traders. Swing traders hold their positions for a few days. So this can be 2 days, 3 days, but seldom more than a week. Identifying and riding on trends earlier is a central objective of this trading style, and the profit objective tends to be set higher than that of day trading. Let me just put my sound down. I forgot to do that. Right. So basically, a swing trader will set objectives which tend to be set higher than that of a day trading, since the swing trader is expecting that by holding out for a few days, there's a better chance of capturing a larger price move. Unlike the day trader, the swing trader has to endure overnight risk. What's overnight cost? Overnight costs are swap fees. So as swing trader requires much less minute-to-minute monitoring of the market, this type of trading is generally preferred by people who hold day jobs. So if you're working the whole day and you don't have time to sit and watch the trades or sit and watch the charts the whole day, I would suggest you do swing trading. Look at swing trading and swing trading strategies. My opinion is that swing traders must still keep up to date with the latest fundamental and technical changes in the market, even when they're not monitoring the market all the time. Because things can change. The market makers and fundamentals can change. There can be a catastrophe in a particular country. Remember, forex trading is one country versus another country. So if something very terrible happens in one particular country, that could affect the pair dramatically. Swing trading is a trading style that aims to capture short and medium-term gains over an extended time frame. Okay, it is among the most popular forms of active trading. Why is it popular? Because most of the people have got a main job and trading is a second income. Swing traders look for medium-term opportunities using various forms of technical analysis. They usually hold their positions open for a couple of days or even up to a couple of weeks to profit from an anticipated price move. Swing trading requires fewer efforts and dedication. Well, they need efforts and time dedication than day trading. The reason is that it maximizes short-term profit potentials by capturing the bulk of market swings. The essence is to successfully identify where the asset's price is likely to move next. Next, you enter a position and then capture a chunk of the profit if your market forecast materializes. The most successful swing trading aim is to capture just a part of the expected price move. Once they do, they move to the next opportunity. They rarely aim for profiting from the entire market move. Instead, they prefer to make smaller but steadier returns before the market swings against them. So a position trader is a longer term trader. A swing trader is just underneath that in terms of days. A day trader is 1 day. Swing traders primarily rely on technical analysis to identify trading opportunities. Similar to day traders, they might often utilize fundamental analysis and analyze price trends and patterns to complete these strategies. So this is an example of a swing trader. You would trade the swings 2-3 days. You can have a look at the dates at the bottom there, and that will give you an idea. What you should know. Swing trading exposes you to overnight risks, where the price could gap and open the following session at substantially different levels. Establish a risk and reward ratio based on a particular profit target. Stop loss, which is very important, and you must stick to it. Don't keep moving your stop loss down, hoping that it's just going to turn there. You can also aim to take profits or losses based on technical indicator or price action movements. Otherwise, you might end up chasing opportunities that go against your strategy or remain within a trade for an extended period of time. Okay, so what they're saying is, if you've entered here, and you're going up and the price goes up, all of a sudden it drops, and your stop loss is, for example, there, then you can see it's moved below. Rather take the loss over there and re-enter at another period, because look how the price went up. So if price goes up, it drops, it goes up. See the W goes up. There's the change, there's the W again, price goes up. There's the W again, price goes up. There's the goes up. So the swing trader looks at the technical analysis. So there it would be going up, there it would be going up. Higher highs. See higher highs. The trend is higher high, higher highs. So the swing trader would look for technical analysis, would look for a way that they're going to be entering the market and staying in the market for a few days. Scalpers. This is the shortest time frame in trading. It exploits small changes in the currency price. It describes the ultra-rapid action of opening and closing of a position within a few seconds or minutes, with the aim of stealing a few pips from each trade. The profit of the winning trade is small, while the number of such winning trades should be big enough so that these small profits can add up to a decent amount. Scalpers usually need to have access to the tightest spreads and fastest connection speeds possible in order to carry out this bullet speed trading with the tiny profits. They tend to do this many times a day so as to accumulate the little profits that are harvested. So no, you cannot look for the highest lot size that you can and then scalp it and hope to goodness you're going to make the profit. You've got to essentially understand that scalping, you've got to have a stop loss and you've got to have a TP. And you're going to basically be sure of your analysis, because you can't say, well, I think. You can't be forcing the market to say that the market will go up or the market will go down. What is your technical analysis telling you? What are your indicators telling you? What is your confirmation? What is your strategy? You've really got to understand which way you're going in the market, which way you want to trade. Don't move your stop loss. Don't trade without a stop loss. Should the market go the complete other way, rather take a small loss and keep working for profits. Losses must be limited such that one large loss does not wipe out the profits gained for many winning trades. Exactly. So put your stop loss, stick to it, take the loss. Many forex market makers discourage this type of trading as they find it difficult to cover the opposite side of the transaction, given the fast speed and numerous orders entered into their system. Scalpers are the epitome of a short-term trader, as they specialize in profiting from small price changes and making a fast profit of reselling. Everything that we said about day traders is even more valid for scalpers, as they buy and sell at a higher frequency. Successful scalp traders maintain a much higher ratio of winning trades versus losing ones. Successful scalp traders. Not everybody. Usually the average duration of a scalp trade open position and range between a couple of can range between a couple of seconds to a few minutes, but really longer. Often, a scalper can execute over 100 trades per day. Have you got the time to sit and execute over 100 trades a day? Do you have the temperament? Do you have you really need to have, a lot in you to be able to handle all those 100 trades in a day. I'd be buggered. I can't. There's no way that I can trade 100 trades in a day. My mental state will just collapse. You're now probably thinking of how it is even possible to buy and sell every few seconds. The truth is that the majority of the short-term scalping strategy are facilitated by advanced computer algorithms. So, yeah, we've got robots that do scalping, but, if you're going to understand buy and sell on the high, buy, sell. Buy, because why? That's where you sold. If you're going to sell here and price moves above where you're selling, you know that there's a trend. So you're buying, selling. Buy on the low, sell on the high. Price is passing that, so you wait for the candle to close, the next candle open higher, you buy there. You would sell at a higher place. Buy at a higher place, sell. So let's have a look at what sets scalping apart from other trading styles. Don't think of scalpers as some frantic traders who are buying or selling everything out there just for the sake of generating volume. Just the opposite. They have mastered their target markets and have well-established risk management strategies. You have to have well-established risk management strategies, otherwise you're going to blow your account, that allow them to maneuver quickly and efficiently. Similarly to day traders, scalpers don't target huge once-off profits. Instead, they ensure a steady stream of smaller gains, and they multiply based on traded volume. The core idea of scalping is that it's better to build your wealth over time with frequent small additions. The fact that scalpers rely on the sheer amount of profitable trades instead of the individual gains means their strategies are designed to exploit even the smallest opportunities in the market. What you should know. Scalp trades are profitable. The most dedicated market participants out there. Scalp traders are probably the most dedicated market participants out there. They spend hours glued to their monitors, closely checking the markets they are interested in, the relevant news, the market noise that might distort the perspective of their portfolio. If you are just starting, we advise you keep scalping trading at the bottom of your list of priorities. And this is something which I'd like to advise you, because majority of traders get in today and all they want to do is scalp. Quick money, quick make a million, quick. It requires complex skills, expertise, complex tools, a live feed, a direct access broker, a technical infrastructure, and most importantly, the capability to place trades with high frequency. Well, with Eskom doing what it does today, and with the power coming on and going off and our networks today, we've really got to make sure that you have a proper network so that you can enter and buy and sell at the right times and in the right places. So we'll continue on with an intraday trader. Intraday trading is another term used for day trading. The word intraday basically means within the day. In many cases, both terms are interchangeable. Similar to day traders, intraday ones also don't keep open positions overnight. They also rely mainly on technical analysis and indicators to time their positions. However, there are some minor differences that you should focus on to make the distinction clearer. The main difference is that the intraday trader style might be much more frequent and has a shorter open time for each trade. Alternatively, intraday trading might occur in shorter time frames, including seconds or minutes, to capitalize on rapid price changes. Furthermore, intraday traders specialize in buying and selling instruments that are available only within regular business hours. The term intraday trading is often used to refer to traders who aim to capitalize on the new highs and lows of particular securities throughout the day. So, patterns. There's resistance, there's support. The minute price touched resistance, came down support, the minute it broke, you'd enter there and there's another support level. And they would basically look at the intraday, to understand what's happening in the market. They'd look at volumes to make sure that the volumes are increasing or decreasing, and they would track that. What you should know, intraday trading is quite the same as day trading, and was introduced as a term to define different pricing data tiers more precisely. However, there aren't many fundamental differences in trading styles and strategies. So whatever we have said about trading has relevance here. So